Good morning and welcome to Bulls, Bears, and the Bell Morning Edition. You've tuned into the deep dive, and our job here is really to cut through all that market noise, give you a sharp, structured view of what's actually shaping the open right now.
Good morning. Yeah, lots to get through today.
Okay, let's unpack this. We are diving deep, as always, into the pre-market intelligence. It's September 23rd, 2025, and honestly, if there's one theme jumping out, it's conflict. Almost a kind of violent disagreement between, say, micro-level excitement and macro-level worry.
That tension is absolutely spot on. It's the core dilemma, I think, for pretty much every portfolio manager looking at their screens this morning. I mean, think about it. Monday's session closed with major U.S. indexes, the S&P 500, the Dow, NASDAQ, all hitting fresh all-time record highs.
Right, which shouts optimism, rampant optimism even.
Exactly.
Yet here we are looking at the screens right now, and U.S. futures. They're pointing toward a cautious open, maybe even slightly negative. And that, well, that just doesn't immediately click for the average person, does it? Celebrating huge milestones yesterday, then bracing for a down day today.
It's the classic definition, really textbook even, of a negative divergence. And it tells you a lot about investor psychology right now. Yesterday's record close, that was celebrating specific, undeniably strong areas, mostly concentrated in a few high-growth spots.
Okay.
But this hesitation we're seeing right now in the futures, that's the reality check. It's driven purely by anticipating risk that's coming down the pike.
So are you saying investors basically saw those record highs and thought, okay, good time to cash in some chips, secure a profit?
Precisely, or at least hedge their bets. They're actively squaring up positions, maybe reducing some exposure before what they know is going to be a day packed with potentially market-moving information.
Gotcha.
So our mission today, for you listening, is to provide that clear, structured view of their, let's say, four main forces really stirring up this conflict. We've got everything from those AI catalysts that seem to be defying gravity, all the way to some complex, very divergent reactions we're seeing in markets around the globe.
And the core question we really need to drill down on today is, why the hesitation? Why this immediate pullback right after such a strong close? And the answer, well, it seems like it usually does. It boils down to the Federal Reserve and data that's coming.
Yep, the Fed looms large.
Let's jump straight into that mechanism then. What's driving this tension?
Right. So to understand why futures are stalling, you really have to look at these two sort of dueling forces inside the U.S. market itself. On one hand, you've got the engine of growth, and it's running, maybe hotter and more concentrated than we've seen in quite some time.
And that engine is, well, it's pretty obvious, isn't it? The AI fervor, that seems to be the primary bullish force. It's just relentless, this AI investment idea. It keeps driving momentum, almost ignoring all the usual talk about, valuations being too high or growth cycles slowing down.
It really is technology pushing fundamentals aside, for now at least.
Yeah.
And look, this is more than just, general hype. There was a specific, pretty massive catalyst just this week that seemed to validate that whole AI investment cycle. I'm talking about the landmark investment announced by NVIDIA into OpenAI.
Okay, here's where it gets really interesting for me. Because a strategic partnership or a big investment like that, coming from a company like NVIDIA, they're basically building the plumbing for the whole AI revolution.
Right. That's a good way to put it, yeah.
So a move from them sends a much stronger signal, I think, than just, say, a company beating earnings estimates.
Oh, absolutely. You nailed it. That announcement, it basically confirmed institutional conviction at the very highest level.
Yeah.
NVIDIA isn't just, selling chips anymore. They're strategically linking themselves to what comes next, the next generation of massive language models, the applications built on them. And that immediately sent positive shockwaves, lifting the whole tech sector, especially related areas, cloud computing infrastructure, data centers, advanced chip design firms, all got a boost.
So it wasn't just an NVIDIA story. It was like a validation for the whole neighborhood, suggesting the big players are really doubling down on what's coming next, innovation-wise.
Exactly. And that energy, that was really enough to push the indexes to those record highs we saw yesterday.
Okay, so we have this incredibly powerful AI engine pulling the market up, almost like it's defying gravity, especially in tech stocks. But you mentioned there's also a heavy brake being applied to the whole system. What's that?
That brake? Well, it's the overwhelming fog of Fed uncertainty. That's the simplest way to put it. The market is just desperate, absolutely desperate for some clarity after what was, let's be honest, a very confusing event.
You mean the first interest rate cut of 2025?
Yeah. The communication around it was problematic. Poorly handled, frankly.
But hang on, a rate cut, that should be good news for stocks, right? Lower rates usually mean easier money, better for asset prices. Why would that cut actually create more instability?
That's the million-dollar question. It's because the communication since the cut has just been all over the place,
Yeah.
completely inconsistent. It's muddied the waters terribly.
How so?
Well, immediately after the decision, you saw this clear split among the regional Fed presidents. For instance, you had some governors saying publicly that inflation risks were still, acute, that
Yeah.
maybe further cuts would be premature, or they depend on very specific data points hitting just right.
Okay, the Hawks.
Right. But then you had other officials focusing almost entirely on, say, slack in the employment market and the need to get ahead of any potential slowdown. The doves.
So you've got inflation hawks basically contradicting the employment doves almost every other day. That kind of mixed message just paralyzes investors, doesn't it?
It really does. It just removes any sense of predictability, which traders, they crave that. These conflicting statements have created what our intelligence report rightly calls a fog of uncertainty. Uncertainty about what? About the speed, the depth of any future cuts.
Is this just a one-off cut? Or is it the start of a whole easing cycle nobody seems to know?
Nobody knows. And that is precisely why all eyes today, are laser-focused on Federal Reserve Chair Jerome Powell's speech later. It's really the only thing out there with enough institutional weight, potentially, to cut through that fog, to offer some kind of guidance on where policy might be heading. Specifically, is the Fed willing to live with slightly higher inflation if it means keeping employment strong? That's the trade-off everyone's watching.
Okay, so AI engine pulling forward, Fed uncertainty slamming the brakes. But you also mention secondary drivers, more sector-specific stuff, adding a lot of volatility, which makes navigating the open even harder. You mentioned the surge in M&A activity.
That's correct. Yeah, we've seen a definite measurable uptick in mergers and acquisitions,
Yeah.
pretty much across the board. And that naturally creates significant volatility, but it's very stock-specific. The activity seems quite concentrated in the sectors our sources flagged, healthcare and real estate.
Now, I have to push back a bit here. If companies feel confident enough to go out and make major M&A deals, doesn't that signal pretty strong corporate confidence, good financial health? Shouldn't that actually be broadly bullish for the market? Why would it act as a volatile or, grounding force?
That's a really great question.
Yeah.
And it gets to the granularity of how markets move sometimes. M&A, yes, it creates excitement, but it's usually very localized excitement. Think about it. If a huge pharma company buys a small biotech firm, pays a 50% premium, maybe the whole healthcare index ticks up 1% just on speculation about, maybe there'll be more deals like this.
Right.
And that's fantastic news if you happen to own that biotech stock or others like it.
Okay, I see. But that specific excitement doesn't automatically translate into broad confidence about the whole economy.
Exactly. That localized fire, it doesn't mean the whole system is warming up. That pharma acquisition, for instance, it doesn't really move oil futures, does it? Or consumer staple stocks.
Yeah.
Or change bank valuations much.
Right.
So in a time like now, defined by high macroeconomic uncertainty, M&A is often seen more as idiosyncratic. Specific risk, specific reward. It focuses capital on individual company performance or maybe strategic repositioning rather than a broad market bet. And that tends to keep the wider indexes somewhat grounded.
And why healthcare and real estate specifically seeing this surge?
Well, healthcare is often about consolidation. Companies trying to get more efficient, deal with patent cliffs coming up, that sort of thing. Risk management. And real estate. That's often positioning based on the expectation of lower borrowing costs down the road. Companies with stronger balance sheets seeing an opportunity to snap up distressed or maybe undervalued properties now, betting that financing will get cheaper later. It's calculated optimism within those sectors, definitely, but it's not broad market euphoria.
Okay, let's shift gears and look overseas for a moment, because those international markets, they really set the tone before the U.S. even opens. And the picture in Asia this morning, well, it was decidedly mixed. Generally subdued, actually. It suggests the rest of the world isn't quite ready to fully embrace yesterday's U.S. record highs.
That's right. Yeah, Asian equities finished a session that, really failed to capitalize on that Wall Street momentum. If you look at the broad measure, the MSCI Asia Pacific Index, it just showed a general lack of conviction. It suggests regional investors were probably more focused on their own domestic issues, or maybe that macroeconomic break we talked about, rather than the American engine.
And we also need to factor in the logistical side of things. Tokyo was closed, wasn't it? For the autumn equinox holiday.
That's a critical point, absolutely. Especially for liquidity. When one of the region's biggest exchanges, like Tokyo, is offline, overall trading volume just dries up significantly.
Makes sense.
So trading becomes thinner, and often any selling pressure that does pop up can get magnified because there just aren't as many buyers around to soak it up.
Yeah.
We definitely saw the impact of that thin trading in some key areas.
Right, mainland China and Hong Kong really stood out as underperformers. The Shanghai Composite dropped substantially, what was it, about 1.0% to 1.2%, and Hong Kong's Hang Seng fell 0.7% to 1.1%. Analysts seem to be pointing to two main reasons for that weakness.
Yeah, two distinct causes. The first one was pretty straightforward. Technicals. After what had been, a pretty impressive rally over several months, Chinese stocks were just technically due for a pause. A breather, as they say.
Yeah.
Think of it like a marathon runner, right? No matter how fit you are, eventually you need to slow down, catch your breath before you tackle the next big hill. So you saw large institutional players likely running programmed profit-taking trades, locking in some gains, resetting their technical indicators. That leads to a pullback, it's expected.
But the second reason, especially in Hong Kong, added this really interesting layer of pure logistical risk.
Yeah.
That approaching Super Typhoon Regasa.
Yes, Super Typhoon Regasa, a literal force of nature impacting the markets. It disrupted trading volumes just by creating operational uncertainty for the whole financial hub. I mean, when you have a Category 5 storm bearing down...
Yeah, everything gets complicated.
Right. Staff might have trouble getting in. Institutional trading desks are probably less liquid. Some systems might even operate on reduced capacity just as a precaution. So this compounded that technical selling pressure with a very specific, time-sensitive logistical risk. That naturally dampens confidence and just reduces overall participation in the market.
Now, switching focus slightly, if we look over at India, they seem to be facing a completely different kind of pressure, and a very specific one coming straight out of Washington, D.C., apparently. The Sensex closed down marginally after a pretty volatile session, and it seems driven by really acute investor concern about U.S. policy.
This is maybe one of the clearest examples you'll see of foreign policy translating almost instantly into domestic financial pain. The concern was focused entirely, laser-like, on the Trump administration's proposed steep hike in H-1B visa fees.
Okay, explain this for our listener. Why does hiking visa fees in the U.S. immediately send the Indian stock market wobbling? On the surface, it sounds like maybe a localized labor issue over there.
It's anything but localized for India. It's almost existential for one of their absolute biggest economic engines. I'm talking about India's massive IT services industry. We're talking about $283 billion. Companies everyone knows, like Tata Consultancy Services, Infosys.
Right, the big outsourcers.
Yeah, exactly. They rely incredibly heavily on that H-1B visa program. That's how they place their skilled tech talent directly at client sites, primarily in the United States. And these companies, they often operate on really, really thin profitability margins, often working on fixed-price service contracts that might have been negotiated months, even years ago.
I see where this is going. So if the cost of actually getting that talent physically into the U.S., the visa fee suddenly triples or quadruples.
The entire profitability structure of those existing contracts just collapses. The hike eats directly, immediately into those margins. So investors, they don't see this proposed policy as just some minor nuisance. They see it as a material threat. A threat to the immediate earnings and maybe even the future business model viability of that entire crucial sector. The market reacts instantly because it has to price in that future profitability risk now.
And the financial impact wasn't just theoretical, it was immediate, visible, tying this geopolitical risk straight to the currency market too, right? That policy threat weighed heavily on the Indian rupee.
It absolutely did. The rupee fell to a fresh record low against the US dollar. When you see a currency hit a record low purely in response to a policy proposal from another country, that's a flashing red light. It signals acute investor fear, maybe about capital flight risk. It just demonstrates that policy decisions around things like immigration and labor in a major trading partner like the U.S. are now completely tangled up with the market health of key developing economies. Investors are trying to price in the possibility that this huge river of revenue flowing from the U.S. might suddenly become significantly less profitable.
But even amidst all this weakness across the Asian session, we still saw that powerful global AI tailwind managing to provide some lift, proving that engine is truly operating across continents.
Absolutely. The exceptions really prove the rule here, the rule being the dominance of the AI trade.
Yeah.
Chip-related stocks, pretty much across Asia, saw gains, and they were directly buoyed by that NVIDIA OpenAI news we talked about earlier. It just reinforced how truly global this AI theme is. It provided a significant tailwind for the whole semiconductor supply chain.
Yeah.
You saw, for instance, South Korea's Kospi, which is heavily weighted towards memory chips, component makers. It actually managed a modest gain, maybe 0.3% to
Yeah.
0.5%. Why? Because those chip stocks, the ones directly feeding the ravenous demand from data centers, they're just so integral to that index's performance. Okay, now let's cross over into the European session. What we saw there was actually a more resilient picture, even, a positive start to the day. European bourses opened broadly higher. The pan-European SINOXX 600 index was up maybe 0.3% to 0.5% in early trading.
And what was fueling that? Primarily optimism about potential rate cuts down the line, right? But kind of reflecting hopes that maybe the ECB might follow the Fed's recent move eventually. But also some specific corporate news seemed to be driving things too.
Yes, that rate cut optimism was definitely part of the backdrop. But the clear sector leader today, the standout performer, was renewable energy. And the story behind that offers, I think, one of the deepest dives into cross-border dependency we've seen in quite a while. It's fascinating.
Okay, lay it out for us. Let's look at the anger story here. Shares of the Danish wind power giant Ørsted, they jumped sharply. I mean, a massive move, 7% to 9.4% in early trading. That's astronomical for a blue chip company that big.
It really is. And get this. What triggered that incredible surge? It wasn't some huge new Danish government subsidy. It wasn't a new EU energy directive. Nope. It was a ruling by a U.S. federal judge.
Wait, seriously, a judge in the U.S.?
Yep. Ruling that Ørsted could restart work on its nearly finished Revolution Wind project, which happens to be located off the coast of Rhode Island.
Hold on. A single court decision in the United States dictates almost a 10% stock price move for a massive Danish utility company. That seems incredible. What was the legal fight about? What was holding up the project?
Well, the project had basically been stalled. There was an injunction filed by some local fishing groups and also some environmental groups. They were challenging specific permits that U.S. federal agencies had granted, mainly under the National Environmental Policy Act, NEPA.
Okay. Standard procedure challenges.
Pretty standard, yeah. But the judge's ruling essentially affirmed that Ørsted had jumped through all the necessary hoops, met the criteria, and could proceed. Now, the significance here isn't just, oh good, the project can move forward. It's that this specific project represents hundreds of millions of dollars in capital that was basically locked up, uncertain. And instantly, with that ruling, it became potential revenue-generating future cash flow.
So it de-risked a major investment line item on their balance sheet, essentially.
Immediately. And that favorable legal development, it didn't just boost Ørsted. It created this powerful ripple effect across the entire continent. It lifted shares of the whole European wind energy subsector. You saw turbine makers like Vestas, their German peer Nordex, both up around 3% each.
Yeah.
Just on the back of that one U.S. ruling. So what's fascinating here, what's really critical for investors to grasp, is this dynamic it reveals. You had an entire sector surge. A pan-European bullish event triggered not by anything happening in Europe policy-wise or economically. It was triggered by a legal decision made within the U.S. court system concerning purely U.S. domestic regulatory risk.
Okay.
It demonstrates pretty definitively, I'd say, that the whole investment case for these big European clean energy leaders who obviously rely on the huge open coastlines of the U.S. for their large-scale projects is just heavily, heavily dependent on what happens in the U.S. market. Policy, regulations, the legal environment.
So if you're a portfolio manager thinking about allocating capital to European green energy stocks right now, you can't just analyze, say, the regulatory framework coming out of Brussels or energy pricing trends in Germany. You actually have to dedicate serious resources to analyzing U.S. political risk, judicial risk even.
Yeah, that's exactly it.
The core investment argument for a company like Ørsted or Vestas lies, maybe to a surprising degree, in Washington, D.C., and apparently Rhode Island courtrooms. That completely changes the due diligence homework you have to do.
Precisely. It fundamentally shifts the analysis. It makes the U.S. political and legal landscape an essential, non-negotiable part of European sector analysis. It's not just some background macroeconomic influence anymore. It's a direct micro-level operational factor.
That's a key insight. Okay, alongside that sector drama, Europe was also digesting some economic data this morning, right? The flash PMI figures for the Eurozone?
Yes, those came out. And they provided overall a powerful positive signal, although maybe a bit uneven. Flash PMIs, just as a reminder for listeners, they measure current business activity, they survey purchasing managers, so they give you a really timely snapshot of manufacturing and services health.
And the headline was good.
The headline was quite good. The data showed that business activity across the Eurozone in September actually grew at its fastest pace in 16 months. That was better than expected, and it does suggest a real degree of resilience, maybe even some momentum building in the Eurozone economy.
Okay, that sounds broadly excellent then, maybe shaking off some of those earlier fears about a slowdown. But you mentioned unevenness. You can't just paint the whole Eurozone with one optimistic brush, can you?
No, not at all. The recovery, it remains very segmented, highly segmented. While Germany's composite PMI, reflecting the bloc's industrial powerhouse, showed accelerated growth, which is a very clear positive
Oh,
sign.
yeah.
French economic activity actually contracted, and it came in below forecast, so that highlights a clear divergence right there. The Eurozone overall might be recovering, yes, but key member states are clearly moving at different speeds, facing different sector-specific headwinds. So while the overall direction seems upward, the underlying structural health is still pretty complex.
All right, let's bring it back home now to the U.S. market, right as we approach the opening bell. Let's really solidify that negative divergence we kicked off with. We had record closes for the S&P 500, the Dow, the NASDAQ on Monday. Huge day. Yet, U.S. stock futures this morning are firmly pointing towards a cautious open, maybe even a slightly negative one.
Yeah, that negative divergence, it's basically the market shouting its skepticism, isn't it? While that underlying momentum, especially from the AI theme, it still feels robust, investors are clearly actively hedging or just reducing their exposure ahead of those really critical time-sensitive risk events.
Powell's speech being number one.
Powell's speech is absolutely the one. But also, you've got crucial inflation data coming later this week, too. So people are taking some profits off the table from those record highs achieved on conviction, mind you, and they're repositioning more defensively, bracing for potential uncertainty.
Okay, so what does this defensive posture, this risk-off mood, actually look like when you look beyond just stock futures? If futures are just one piece of the puzzle, what other indicators are confirming this sort of flight to safety?
That's the right question. If you zoom out, look across different asset classes, the picture becomes really clear. It confirms a classic risk-off environment. Money is actively moving out of riskier bets and flowing towards traditional safety nets. We see this confirmed in basically three distinct ways. First, as we've said, equity futures are declining. That's your most direct signal of just a diminished appetite for immediate risk in stocks. Second, you look at traditional safe haven assets. What's happening with gold?
Gold's rallying.
Gold is rallying. Now, gold's movement is typically inverse to confidence, right? Confidence in growth, confidence in policy certainty. When gold moves up, it usually signals macroeconomic anxiety. Could be inflation fears, could be geopolitical uncertainty. It becomes that necessary store of value when stocks feel volatile, or maybe even when fiat currencies themselves feel a bit shaky.
Okay, futures down, gold up. What's the third indicator? You said it's maybe the most telling about speculative behavior right now.
Yeah, I think so. That's the plunge we're seeing in the really speculative assets. Think cryptocurrencies. They've kind of become the global poster child for high-risk, high-reward exposure, haven't they?
For better or worse, yes.
Well, they are plunging in the pre-market session today. When institutional money, or even high-net-worth individuals, decide to seek safety, what's the first thing they usually shed? It's the assets that require the most optimism about future liquidity, future growth, future adoption. Cryptos often act like that canary in the speculative coal mine.
So the rapid drop confirms traders are prioritizing cash, defense, rather than chasing the next big risky move up.
That's exactly how I read it. That combined cross-asset picture, stock futures down, gold up, crypto down, it tells a very unified story. The market is bracing for volatility. It's pulling back from those highly speculative gains we saw recently. And it's actively seeking safety because of this persistent macroeconomic uncertainty. So just to sum up the forces really dominating the open here, we're looking at a market caught in this intense tug of war. You've got the powerful, stock-specific micro-catalyst of AI, that engine of innovation trying to pull things forward.
Yeah.
But at the same time, you have the Federal Reserve's ambiguous policy signals. You've got those geopolitical and logistical risks hitting Asia, the H-1B fears, the typhoon, and just the general need for investors to hedge before Powell speaks. All of that is dominating psychology right now, and it's resulting in this very clear risk-off strategy playing out before the bell.
It really is the tension between, say, fundamental long-term technological optimism, that's what dictates the record highs, and then the short-term policy-driven fear, which is dictating the cautious open today. The AI story is about the next 10 years. The Fed story is about the next 10 hours. #tag outro.
Okay, that brings us pretty neatly to the key takeaways for you, the listener, as you get ready for the market open and start monitoring today's news flow. We've really established, I think, four major dynamics at play today that you absolutely need to keep an eye on. One, that intense conflict. The AI innovation engine, supercharged by that NVIDIA Open AI deal versus the persistent Federal Reserve uncertainty break, which is clearly pushing investors towards safety right now.
Yep.
Two, those specific localized risks hammering parts of Asia, everything from the technical profit-taking in China to that really existential threat the proposed H-1B visa hike poses to India's massive $283 billion IT sector, which we saw immediately slam the rupee.
Crucial linkage there. 3. That critical, maybe underappreciated dependence of Europe's booming renewables sector on what happens politically and legally in the U.S. It proves investing in Danish wind power now means you're analyzing court filings from Rhode Island. It's quite something.
It really is.
And finally, 4. The direct result of all this, that clear risk-off market posture we see playing out right now in U.S. futures, the corresponding rally in gold, and that telling plunge in cryptocurrencies.
And looking beyond just today's open, this whole situation raises a really important question, I think, for longer-term thinking. Something that goes beyond the immediate daily trade. You have the market celebrating these record highs, driven largely by technological exuberance. Yet, at the exact same time, it's hedging aggressively against those very same record highs by piling into safety assets.
A paradox.
It is. So the question for you is this. If the primary engine driving this market, AI, is almost entirely dependent on future innovation, future funding, how long can the kind of economic resilience we're seeing hints of elsewhere, like those Eurozone PMI figures showing the fastest growth in 16 months, how long can that sustain global markets if the path for central banking policy remains completely obscure, just hidden in that fog of conflicting statements?
Right. Is this fundamentally a market that's trying to operate in two completely separate realities? One reality where technology always wins out in the end, almost regardless of the macro conditions, and another reality where policy uncertainty always trumps everything, trapping cash on the sidelines. That's the tension, isn't it? The tension you need to watch unfold, especially as Powell speaks later today.
Absolutely. Keep exploring those cross-border dynamics too, especially how a single U.S. judicial decision can ripple out and effectively dictate the performance of an entire European sector. It's a fascinating and I think increasingly important dynamic for global investors.
Indeed. Okay, that's it for this deep dive. We really hope this structured view helps you navigate the ongoing conflict between the bulls, the bears, and the opening bell. We'll talk to you next time.